So they started the VAT here. When did they start the VAT here?
At the beginning of the year.
2015.
Yeah, and how much is the VAT now?
5%.
5%, right?
Why you mentioned now? We need to keep it on the 5%.
Yeah. The reason I mention that is because if you look at what is the world, it's like the petrol prices, right? The petrol prices here, the water prices, electric prices are all lower than the world average. Same thing with the VATs. Like the average VATs around the world is a lot higher than 5%. So that's good news and bad news again. The good news is that it's only 5% right now. Bad news is probably they're going to do the same thing over time because they're trying to diversify revenues, right? Over time, this will go up. Now, I heard maybe this will not go up until 2030, but who knows, right? Let's hope not. But I want to show you guys an example of how this works. So I'm going to skip ahead to the end because a lot of people don't understand how this works. Now, what this is talking about here, this is a UK example, but there could be things that are exempted from VAT, right? In some cases, you have exemptions. I don't know if they have exemptions here or not. Do they have exemptions here? So who would not have to pay VAT? What sort of companies get an exemption here? Okay, yeah. Yeah, so in this case, there's always some exceptions in this case across most countries. So that's pretty normal in this case. Or you could have reduced rates in certain cases. I don't know if they're doing that here or not. Look at this one, 20%, you guys, is a standard rate in this case. Their reduced rate is 5%. So something to look forward to. In this case, no VAT on these items here, right? So some food, so some people don't tax food. I think in the US, for example, there's no sales tax. It's not a VAT, but no sales tax on certain food. I'm not sure about here. And these ones is too, health, like you guys mentioned. Sometimes education. Do you guys have to pay VAT on education here?
Yes.
Yeah.
This is school, yes.
Okay, nice. Okay, so I want to jump ahead to the example here, you guys. This one right here. So this is showing why it's called a value-added tax and not a sales tax. So the first thing that happens here, we have a toy maker, right? And they're going to sell the price. They're going to sell it for 200 pounds or SAR, whatever we want. And the VAT rate is 17.5%, which is higher than 5%. So this is the VAT that's paid. Now, here, right, you have to register with the government. You get a VAT number. You have to collect the VAT, and then it's your job to pay this, whatever it is, every monthly or every quarter to the government, right? So in this case, how much are they going to pay to the government? 35. That one's done. Okay, now they sold this to a wholesaler. Now when the wholesaler buys this, they get a receipt, right, from the toy maker that says you paid 35 in VAT. You paid 35 in VAT. So this ends up being a credit for you. This is a credit for you. And I'll show you how that works. Now you're going to resell it, and you resell it for 300, right? When you resell it to 300 to the retailer, you're the wholesaler, you're going to sell it to the retailer for 300. You charge them 17.5% of the VAT, right? So you collect 52.5 from the customer. But how much do you send to the government? Do you send them 52.5 or not? That's the question. You get to,
Minus 35.
yeah, you minus the VAT you already paid. That's why it's called a value-added tax. You added 100 in value, so you're going to only have to pay the VAT on the 100. So you have to keep track of this in your accounting system. The accountants keep track of this in the accounting system, how much the VAT is paid. And of course, you need the proof, right, the receipts with their VAT numbers. If they didn't register for VAT, then I guess you're out of luck. You'll have to pay it. You don't get to deduct VAT if they didn't pay the VAT. So this is kind of a good system too for the government, right? Because it encourages you to say, hey, register for the VAT so I can get a deduction. Okay.
This in UK, here the same?
Same thing here, same thing here. So this is 17.5 you pay to the government. Now you sell that to the retailer for 400, right? Who's going to collect 70 from the ultimate customer, right? This is the ultimate customer. They pay 70, but they again get to deduct the VAT they paid when they bought it from the wholesaler. So they only pay 17.5. And if you add up everything that was then eventually sent to the government, the 35, the 17.5, the 17.5, it's 70. And 70 divided by this is the original VAT of 17.5%. So the government ultimately collects the 17.5%, or in your case, the 5% of the final sales price, right? That's all they collect. As opposed, because some people were thinking there'll be 5% on the first one, plus 5% on the second one, plus 5% on the third one, and the government just kind of almost tripled their money, but it doesn't work that way. Sales tax would work that way. A sales tax is like that. You don't get a deduction for previous amounts that are paid. At every level, you pay this sales tax. And that's why the sales tax generally tend to be lower than the VAT rates.
Lower?
In general,
We have it 17 in Jordan.
for a sales tax or a VAT?
Sales tax.
But it's accumulative. In Jordan also accumulative.
It's the same sort of method,
Same of that.
like a VAT?
Yeah.
Yes,
Oh, okay.
Not accumulated.
accumulative.
Interesting. But yeah, I just want you guys to understand this piece. So that kind of makes it seem not quite as bad as people may have thought when this first came out, right? Because of this method. So do you guys understand that? Is that okay? That's VAT. Okay,
So
last.
the sales taxes, they will, the toy maker, he will pay, let's say, 17.
Yeah, if they're paying 17.5, if that's a sales tax, the government collects 35, 52, and 70. In America, that's the way it would work, because we don't have VAT, we have sales tax. But it's not 17.5%. It varies by states.
I think it's 6. Some states.
Every state is different. And the bad thing about this, the bad thing about taxes in general, like in California, they have a pretty high sales tax rate. I forget what it is. But what happens is every time they have a natural disaster, like a wildfire, earthquakes, they have everything, mudslides, flooding. Oh, we'll raise the sales tax like 0.25% to pay for the damage for this, right? But they never lower it, right? It only goes higher. And that seems to be the case with a lot of taxes, right? It just goes up and up and up and up and up. Yeah.
But I think it is 0 in other states, right?
Yeah, exactly. You have
Florida, I think.
zero sales tax. There's a sales tax in Florida, but there's no income tax in Florida. There's no income tax. No state income tax. You still pay federal income tax. Taxes are fun. I'm just kidding. Let us go to lean accounting quickly, and then we can just talk about the final a little bit. And then you guys are done. Here it is. Now, lean accounting, we pretty much covered all of this stuff before, but there's a piece we didn't talk about that this touches on briefly. There's a whole, you can spend a whole semester on the topic that I'm going to talk to you guys about just briefly to give you guys some idea. Okay, so in terms of lean accounting, this to me is kind of like operational stuff. So what I do for companies, if I'm working at a company, and this is what you would do in operations if you guys have worked in operations before or taken an operations class, is you can do a process flow chart of your operations, right? What are all the steps you need to take to go from point A to point B? I did that my first job out of college, right? My first job out of college was to automate different things. We had, what we had here is we had two different systems at our company. We had a trust system and a general ledger. So we had this trust system. And we had a general ledger, which is the accounting system, right? And what we had is, do you guys know what a trust is? A trust, you can set up a trust fund for your child, right? So you put $1 million into the trust fund. But the trust fund comes with stipulations. We, as the trust administrators, will invest the money for you and make the trust grow and charge you a % of the fee, like the mutual funds, for our services. And then that has a bunch of rules attached to it. Okay, so if your son or daughter, once they become age 30 and they're married and they finish college, then we can give them some income from this trust fund, right? But if they screw up, we can pull it back. It's kind of an incentive system. But every quarter we'd print out these stack of invoices to send to the customers. And the stack of invoices is like this high, right? And what they would do is they'd manually key this into the general ledger system. So my first job there was to, once I understand the process, right, and how long this is taking, I target the ones that take the most time, that are the most manual, right? And this was one of them. It's taking like 16 hours a week. So if you can automate that, you're going to save a lot of money, right, as a result. So what I did is I was able to capture the electronic file from the printing thing. And there's a program called Monarch where I could extract the fields into a database file, load that into another program that I made that reformatted it, and then electronically send it over to the general ledger. And it's done in like 10 seconds, right? The whole thing's done in 10 seconds. So part of what lean accounting is talking about is if you map out the process of anything in your company. It could be the operations to make something at the factory. It could be the process you go through for keying stuff into your general ledger. Think about what you guys are doing in your daily jobs. What are the steps that you're doing? If you map out what is step number 1, how long does that take? What is step number 2, step number 3, step number 4? If you find out which one takes the longest, right, that's the one you should target first. If this is 1 minute, 2 minutes, 3 minutes, and 1 minute, right, if you improve this one, then that's the one you should improve first. This is like the bottleneck. This is the bottleneck. So that's part of what we're talking about with the lean accounting is process improvements, right, making things more efficient and leaner and things like that. And again, if you flowchart things, that will be much easier to do. The other concept with the lean accounting is that we don't like inventory as much in lean accounting because there's bad things about having inventory. Inventory is what? Is that an asset, liability, or equity, you guys? Asset. So if you think of inventory as an asset, is that good or bad? It's good because it's valuable, but there's some bad things about inventory, right? If we have unlimited inventory, right, more and more and more stuff, is that good?
No.
Yeah, because bad things can happen to our inventory, right? It can become outdated. It can go bad if this is food and things like that. So ideally, you want to find ways to minimize your inventory. And this is another concept with the lean accounting, having as little inventory as possible. And if you do the correct planning, you guys can manage the inventory better. Again, we need data. You don't want to have what's called a stock out. Do you guys know what a stock out is? Stock out means it's just not there. And this drives me crazy because when I go to the Philippines, I go to a fast food restaurant down there. I don't like fast food normally, but sometimes you got to eat it and because you're hungry. And so I go to Jollibee, which is like their McDonald's, and then they have this stuff. I don't like most of it, but I'm like, okay, this one, I'll take that one. I'm sorry, sir, that's not available. I'm like, that one, nope, not available. I'm like, what do you have? What's available? That drives me crazy. Never happens in the United States. Why doesn't it happen in the United States? Because they track this stuff. They estimate what is the demand for this product, what's the variability in the demand for that product, and they calculate that they have enough so that their odds of running a stock out are low.
Safety stock.
Yeah,
Safety
Minimax.
stock.
Exactly.
Safety stock, and based on the historical data, you can put the safety stock that cannot do. Eurostock cannot go below than this.
Yes, exactly,
We
exactly.
call it minimax, the minimum and maximum.
Yes.
Once reached to the minimum, it will give you alarm, so we'll buy.
Minimum order level, we call it.
Yeah, so you guys are aware of this stuff. So that's the concept here. Avoid the stockouts, but if you have too much inventory, this is costly because it can go bad. It costs you money to store the things and like that. So you want to be as lean and efficient as possible with the inventory. The other thing I want to show you guys is near the end here. Other stuff they're talking about in the chapter is talking about benefits versus costs. But again, we've already done that, right? We talked about this in economics, marginal benefits versus marginal costs. And they're talking about this here as well. So cost-benefit analysis. This is economics, right? And in general, yeah, if the benefits exceed the costs, you should do it. However, I don't like this method. Why don't I like this method, you guys? If we just calculate benefits versus costs, benefits greater than costs, we should do it or not?
There is opportunity cost, not here. So
Yeah, it doesn't consider the time value of money. So I'm okay with this as long as these benefits are present value. As long as we present value these benefits and present value the costs, then yes, we can do that. And if we're present valuing this, this is simply net present value. This is net present value. That's what you guys are doing in net present value. We look at the cost, which is the investment. We look at the benefits, which is the future positive cash flow. But we present value it back to the present before you guys compare them. So I don't care if we use this method, because in general this is true as long as these are present value. That's okay. If it's not present value, then this is not really accurate to do that. Okay, so this one we've already talked about. And these are things we can evaluate. In some cases, you don't necessarily need to do net present value, right? Do you guys want to do net present value for evaluating new hires? In this case, are you going to do a net present value? I don't do a net present value necessarily in this case, you know, if it's one person, but still you should still think of it like this. You should think of how much are they going to cost you, right? And they should pay for themselves, right? So what are they doing at your company that's going to pay for that, right? Either my revenue has to go up as a result of this hire, or they have to somehow reduce my costs. So if you guys can somehow find a way to track that for employees, this is good, right? This is good. So for salesmen, we can do this more easily. But if you're in accounting, this is difficult to do, right? That's difficult to do. But it's good to think about this. They should be adding value to your organization.
There was a profit center and cost center. Is it in the finance?
Yeah, this is in the slides here. And this relates to finance, different reporting things. This one, of course, we're using MPV for. Measuring social benefits. The government's going to do that, right? The government's going to do that. So this one we've talked about in terms of MPV, right? We identify the costs and the benefits, calculated them, compare them. The thing it doesn't mention here, though, is time value of money. So if you guys are doing this, just make sure we're using time value of money. Okay. Now the thing I want to show you guys is at the end, which relates to this one right here. Not this one. Yeah, so take a look at this one. What do you guys think of this cost-benefit analysis here? Is there any problem with this that you guys can see? So these are project parameters, right? Financing costs per year, things like that. So far, so good. And then we have total construction costs, so total costs here. And total benefits here, right? And profit. What's the problem with this, you guys?
Duration.
Yeah, duration is this is implying that that these numbers are over time, right? Over time, and they're simply adding up total costs and total benefits, which is not correct. This is not correct. So again, MPV is a better method than this. So I do not agree with that. Okay, cost center versus profit centers. I don't know if you guys use these in your organizations. Do you guys have cost centers and profit centers? What kind of cost centers do you guys have? Yeah, so this could be considered like departments in this. So the idea here is that you have different reports for different centers that you want to track, right? So like for us, we normally break this into departments or products, and you track those independently so you can measure product profitability and things like that. So we've talked about overall profitability, right, for the company. But there's other types of profitability that you guys can do. So there's company profitability, which is good to know. But also, like in the company I worked at in Florida, we did more than that. We broke this into product profitability. We have product profitability. And when you guys do this, this gets a little bit tricky. Why does that get tricky to break your total profit into product profitability? Do you guys know what are some of the difficulties in doing that?
The fixed cost maybe, or
Yeah. This is one of the main things, right? So the company I worked at in Florida, we had one big office, right? There's one big office, and we're renting that office, right? So say the rent is like, I don't know what it was, $50,000 per year. And we have 5 products. We had like 401k, BOLI, COLI, investment advisory, say these 4 products, right? And say we're making a revenue here of 20 million, 30 million, 10 million, and 10 million, right? So we know what the revenue is. We can break the revenue out pretty easily. We can maybe get the direct costs. If we know which employees are working on which one, we can add the direct costs in here. That's good. But for shared things like this, we have to decide on a methodology for allocating those fixed costs into that. And there's different ways to do that. Some people do it by, if you're in a factory, you look at machine hours, things like this. If you're using a machine for different products and you keep track of the machine hours, you can then allocate based upon machine hours. Some people allocate based upon labor hours. So we can use machine hours, labor hours. You could make it a % of total revenue. So if they have most of the revenue, we'll make them pay most of the rents, things like that. There's not necessarily a right or wrong answer here, but you should be consistent and it should be logical when you guys are doing that. Yeah, so that's what this is alluding to here, how to break out the profit into different sectors. You can also do customer profitability. So at the end, there's another example for you guys that I want to show. So this is what we're talking about here, cost allocation. How do we do this? And again, you can spend a whole semester on this particular topic. But we're just kind of introducing to you that this is important. And we call this cost accounting. This is cost accounting. So if you guys really want to do this for your company, you should get somebody who does cost accounting. That's called cost accounting. And they specialize in doing this stuff. Okay, so take a look at this one, you guys. Okay. Now, manufacturing overhead. Do you guys know what manufacturing overhead is? What is manufacturing overhead?
The machines,
Direct and indirect.
Yeah, so there's some costs that we can't easily allocate to the product, right? And this is the overhead, like the electricity at the plants, the managers of the factory and things like that. So there's direct labor and there's indirect labor right at the factory. Who's in direct labor, you guys?
Direct labor, finance.
HR.
Yeah, even within the factory, right? Even within the factory,
We can say the supporter.
you can have direct and indirects, right? People who are actually making the stuff, and then the supervisors, the cleaner, and things like that, who aren't directly involved with the product, they all have to be allocated. So the total of all this indirect stuff is the manufacturing overhead. And then we need some way of allocating that back, because the direct we can already trace it through. So this is what we were talking about before. Okay, and this is a way to do that, right? We can take the total costs, divide it by some activity measure. Like an activity measure could be like machine hours or labor hours, things like that. And then get the allocation. Okay, so take a look at this one here, you guys. This is just a really simple example. I'll let you guys read this for a second. Have you guys ever gone golfing before? Any golfing? No golfing? It's fun. It's a little bit frustrating sometimes. If you can't hit the ball, this is frustrating, but it can be fun. Okay, so in this case, right, they had, they're going to allocate things by machine hours, right? So the titanium shaft requires 54 hours of machine time. The aluminum shaft takes 26 hours of machine time. Right? So 67.5% of the overhead costs is going to be allocated to the titanium shafts and 32.5% to the aluminum shafts. This is one way to do it. Right? If they're making these two different products, they're going to allocate it by this activity, by machine hours, right? To calculate the total overhead costs, multiply it by these percentages, and that's one way to do that, to allocate the indirect costs. And then you guys can add the direct cost to it. And then you can figure out the profitability of the product, right? Because we have the revenue, and now we have the costs. And what we're talking about here, you guys, is this part of the income statement, the revenue, and the cost of goods sold, this piece. So when we're talking about manufacturing overhead, this is in the cost of goods sold. Right? The other stuff that's in the headquarters, we also have to allocate that, right? But that's not going to be manufacturing overhead because that's in the headquarters. Okay, and that is that.